Um, I think it's time to begin our session. Hello everyone. My name is Rishi Bhatia, and I will be hosting today's NOCA CPD session. Thank you to everyone who's joined this webinar. NOCA is an independent organization comprising of actuaries who work together to develop and share knowledge and aim to provide excellent service to the insurance and pensions industry. Today's session is titled Modeling Liquid Assets and is being presented by Joseph McCarthy. Joseph is a fellow of the Institute and Faculty of Actuaries and has an MSc in computer science. He has been working as an independent consultant in the UK life industry for over a decade. 9 out of the past 10 years have been involved working on projects for which modeling of illiquid assets has been the central component of the project. Outside of work, energy is not expended in pursuit of his PhD computer science or MSc applied economics are focused on big wave and high performance server training. Joseph is giving this presentation in his personal capacity. The views expressed in this presentation are those of the presenter and are not necessarily the views of his employer or NOCA. The session may count for up to 1 hour of your CPD, provided it is relevant to the nature of your work or role and addresses a personal development need. You can register your questions during the session on Zoom chat or by emailing us at contact@noca.uk. There will also be time for questions near the end where you can ask questions live to Joseph. So Joseph, over to you now.
Thanks, Rishi. And thanks all for attending. So asset modeling in general is a very large topic, too big to cover in one session. The session today is intended to be fairly high level. So the content has been extracted from a much larger training body of training material that I've developed in collaboration with a postdoctoral researcher developing course for university. If there's sufficient interest, we'll make that available for sale. As many of you will know, the BOE released CP 1213 yesterday, a review of Solvency II adapted to the UK market. This means that some of the Solvency II specific references may become redundant in time. I've tried to keep the presentation as high level as possible so that it doesn't kind of get caught up in regulatory specific agendas. That because IFRS and Solvency II are such an important part of our industry, there are naturally references to the way we would do things in IFRS and Solvency II. Right, so without further ado, let us continue. I'm going to start by introducing and defining exactly what an illiquid asset is and give some examples. We'll then work on to define a paradigm that helps us identify exactly what needs to be modeled. We'll then look at the differences between illiquid assets and liquid assets, and then dig into the core principles in asset modeling, notably the RDR and the implication for illiquid assets. Following that, we'll look at the factors required for modeling in more detail, specifically factors required for credit modeling and the RDR. And then we'll discuss how we fit what we've already looked at into the Solvency II paradigm. And following that, there'll be hopefully some time left for discussion and questions. I say discussion because I'm hoping that there will be alternative viewpoints and suggestions as well as questions. Right. So, introduction, definitions and assumptions. What is an illiquid asset? So Investopedia defines illiquidity, or an illiquid, refers to the state of a stock or a bond or other assets that cannot easily be or readily be sold or exchanged with cash without substantial loss in value. Okay, so just like to highlight, they cannot easily and readily be sold without a substantial loss in value. So already when we want to invest in these assets, we need to take note that they're not going to be sellable in stress easily without a significant haircut. And as part of any due diligence, stress and scenario testing needs to be done. So this needs to be factored into any model calibration. If we look at what the FCA says, which is basically the Bank of England or the regulator, they have their own definition of illiquid assets, and it's a bit more expansive, and they include specifically land and buildings, infrastructure, and unlisted securities. So just some examples: CDOs, collateralized debt obligations. So this could be anything really. We know from the past that mortgage loans were collateralized up into debt obligations. In the UK, often agricultural loans in the banking sector get collateralized up. Not so much in the insurance world yet, because they tend to be shorter term than the annuity portfolios that are generally require the assets, illiquid assets. Of course, everybody's heard of equity release. Private placements and bilaterals are similar concepts. Project finance is, of course, money directed into a specific project, which can have a deferred payback period, which obviously increases the risk involved. You've got syndicated loans, for example, catastrophe bonds. And then, of course, you've got direct property. So recently, illiquid assets have come to the spotlight, partly because of Solvency II and the MAIS matching adjustment stress principles, and the desire for pension funds to back annuity portfolios with higher yielding assets or more capital efficient assets. As you can see by these examples, illiquid assets have been around for a long time and take a lot of different forms. We're going to be focusing on the high level principles rather than simply assets that are used to back annuity liabilities. Further, when people tend to think about illiquid assets, they often think of direct property. Direct property is one kind of illiquid asset, but as you can see, there are many kinds, and the principles needed for modeling property are not those needed for modeling project finance or syndicated loans. Right, two assumptions. I'm going to assume attendees are familiar with the primary features of corporate bonds, cash flows, and return of principal, and that attendees are familiar with the primary tenets of Solvency II and IFRS. So what exactly are we modeling? We need to define a paradigm to determine what it is we're modeling. So we're going to start with the required outcomes. The required outcomes are: we need shareholder value, we need embedded value, we need regulatory profit reporting, and we need capital adequacy reporting. Right, so profit reporting, we're generally referring to IFRS. Capital adequacy reporting, we're referring to Solvency II also, and the regulatory framework that most people should be familiar with. Shareholder value and embedded value, we are referring to the risk-adjusted return on capital that would be used in pricing new business. So the required processes to achieve these outcomes, we've got the risk-adjusted return on capital. We need some asset valuation processes to determine the liability discount rate, capital modeling processes, and own risk and solvency assessment. The risk-adjusted return on capital is when the reference here is to a process to determine it. Of course, if you want to determine the risk-adjusted return on capital, you have to understand your risk. In order to value an asset, you also have to understand the risk. Once you understood that risk, you can, according to the current regulations for discounting liabilities, add a portion of that spread to the liability discount rate. Once again, for capital modeling, it's all about assessing the risk, and same with also. So what we can really see is that modeling illiquid assets comes down to understanding the risk involved in them. Because once we can do that, we can achieve everything we would like. So the required factors are the RDR, which is the risk discount rate. And that is a very simplistic representation of what people generally believe to be the RDR and how it should be decomposed. And of course, we've got a non-exhaustive list of risk factors, which are market risks and other. Obviously, I haven't included all other, but operational risk is a risk that is important for modeling illiquid assets. Right, market risks, we're talking about credit, interest rate, inflation, currency, property, and concentration. We're not going to cover all of these in this session. We're going to focus on the ones that need to be modeled differently for illiquid assets. So interest rate, inflation volatility, currency volatility, these risks affect corporate bonds and illiquid assets. Credit, however, and concentration affect illiquid assets differently. to the way they affect corporate bonds. So we're just going to go through this list of items to consider when modeling illiquid assets. We're not going to look at correlations today. They are a byproduct of the modeling process and generally require a lot of expert judgment and a lot of technical discussion. So we're going to skip that bit, but we'll look at the other items. So the spread composition is generally the RDR. Spread volatility is obviously how that changes under stress. The probability of default is the probability of default, which is tied to the recovery rate. In corporate bonds, the recovery rate is generally assumed to be flat 30% or something like that, because they're fairly vanilla and they're typically not secured on an explicit set of cash flows or an explicit asset, as in physical asset, whereas in the illiquid asset world, they generally are. So they are very tied to the scenario that led to the default. This is something we'll be revisiting over and over again, is the kind of interrelational dynamics between these risks. In the corporate bond world, they're often assumed to be fairly independent, for example, PD and recovery rate. In the illiquid asset world, we cannot get away with that assumption because it simply isn't true. Rating transition is, again, something that is historically for corporate bonds has been overly dependent, in my view, on historic data. A lot of it is arguably irrelevant. For example, historic data from the 1930s or 1940s, where regulations and capital requirements were different. However, for corporate bonds, they do give an indication of what could happen. For illiquid assets, where there are no publicly available historic rating transition data, we have to come up with alternative approaches to modeling rating transitions. Of course, rating transition is important because in our regulatory framework, we place a lot of dependence on credit ratings and credit rating assessments. Right, so how does this differ to modeling requirements for corporate bonds? Short answer, it doesn't. We're looking at the same factors. So why not just model illiquid assets as corporate bonds? Because they're fundamentally different. Right, let's move on. So corporate bonds versus illiquid assets. So we're first going to have a look at the typical features of corporate bonds. Then we'll consider the same similar kind of factors to consider for illiquid assets, highlighting how different they are. So corporate bonds are generally exchange traded. They're generally ECI rated. They often have standardized contracts, so low legal risk, standardized features to make them easy to model, a relatively deep liquid market, generally issued by an established entity, as opposed to a startup or a project, standalone project. Fairly standardized risk profile, sectoral systemic risk exposures, relatively homogeneous. By that, I mean that within a specific sector, for example, utilities, their risk exposures are relatively homogeneous, even across geographies. So, for example, if you looked at all the utility or the electricity providers in the UK, they're exposed to pretty much the same sort of risks. There may be a little bit of idiosyncratic, but it diversifies away relatively quickly, particularly when you look at the size of the market. Perhaps the most important difference from a practical perspective is the mark-to-market valuation. So a corporate bond is exchange traded and it has a market value. Illiquid assets, on the other hand, are privately traded. So they have no ECI rating. They're generally bespoke contracts with very high legal risk, bespoke features which require bespoke modeling. They're also obviously illiquid. They can be greenfield, brownfield, project finance, or some sort of combination of these. They often reflect significant non-standard or concentrated risk exposures, for example, off-taker dependencies, for example, a project that has contracted a purchaser of their services, so to speak. If that contractor defaults on providing them with revenue, well, then the project's pretty much over. Unless they can find an alternative off-taker. Prepayment risk is also quite a large risk in illiquid assets, because often the contracts have covenants that say that prepayment can be made. And if you're using these assets to back long-term liabilities, the last thing you want are for them to be prepaid. Obviously, there are project risks, there are regional risks, there's refi risk, which is a risk of refinancing. So often principal amounts are repaid from refinancing. If interest rates go up and the project is unable to refinance, well, then the project might be in trouble and you may not get your principal back. Obviously, there are lots of other concentrated risk exposures. For example, properties. I see somebody has raised their hand. Oh, okay. I see somebody has responded to it. Thanks. Obviously, there are property risks and lots of other idiosyncratic risks that will not be easy to diversify away. What this boils down to is that there is no mark-to-market valuation. There's only mark-to-model. And to get a mark-to-model valuation, you need to be able to model the risk. So, as I said, a big difference is lots of publicly available concomitant and historic data for corporate bonds, and this does not exist for illiquid assets. So just to pause for a second, all of what we've discussed thus far can be summed up in how the risk discount rate is derived. So the RDR is a fairly simple approach to assessing the risk in an asset, and it's used quite widely in the asset modeling world. A problem with the RDR is that it is very historic data dependent, and we're going to have a look at the RDR in a few minutes and discuss exactly what the problems with it are. Because it's very data dependent, there is no ways we can actually use it to assess the risk in illiquid assets unless we determine an alternative approach to deriving it. Right, so cash flow profile, sorry. Right, so conventional corporate bond cash flow profile looks something like that. Got a present value of, the Q is the principal, C is the coupon rate, present value of cash flows, you're allowing for probability of default and recovery rate, discounting at a risk-free rate plus theoretically an illiquidity premium plus the return of principal. So in this case, we can broadly split the spread between the probability of default and the illiquidity premium. And that is what is often assumed, or what has been assumed in a lot of reporting processes over the last 15 years or so. Typical project finance cash flow profile. Now this is simplified. So I've taken this from a model that I built a few years ago. As you can see, it's a lot more complicated. And this is actually a simplified version of it. What this boils down to is that if we want to use the RDR as a measure of risk, we have to simplify or condense a lot more information on the illiquid asset side into the RDR than we do on the corporate bond side. Right. So the RDR, let's have a look and discuss what its components are. So we know that there are two approaches to derive the RDR. The one is a real-world approach, and the other is a risk-neutral valuation. The real-world approach is based on historic defaults, and it basically assumes that the spread can be split between the risk-free and the expected losses due to default. Now, I've simplified this to expected PD, but in reality, it's expected losses due to default. But the way it's often notarized is as EPD. So I've just kept it as that for simplicity. On the risk neutral side, we assume that there is an additional risk premium to explain the historic difference between the market implied spread and the real world spread based on historic defaults. I'll give you a minute to absorb that, but in reality, it's fairly simple. We've got a PD on the left, which is a real world, and we've got a PD plus a risk premium on the right, which is a risk neutral. Now we know then reality that the market implied one is what everything is based on, what fundamental spreads and Solvency II is based on, what the illiquidity premium in the old world was based on. And we know that the RDR generally comprises all three of these elements. We know that we can also derive the risk premium by looking at historic defaults and the market implied spread. And this is essentially exactly what the fundamental spread in Solvency II attempts to do, except that they include the cost of downgrade because default is not the main problem, not the only problem. Downgrade could lead to a loss of MA eligibility. So they include cost of downgrades in this section in the middle, which means that the resulting risk premium must be some sort of illiquidity risk premium. As I said before, the problem with illiquid assets is that the split is not as easy to determine. Right. So let's have...
Just sorry, before we move on the next slide, there are two questions. I think it will be interesting to tackle the questions while we are on that slide.
Okay.
Let's go for the second question first, because that's pertaining to the previous slide. The question is from an anonymous attendee, and they say, is the formula for the real world one will have the risk premium?
Yes.
So will the real world formula have risk premium in it, or?
Yes, so that's the definition of, so let me go back. So that's no, sorry, the real world doesn't have the risk premium. So real world is based on historic defaults. And the literature has shown that generally the risk neutral is higher than the real world. It's a bit of a misnomer to call the real world. It's not really a real world, it's just historic defaults. But yes, see questions appearing and disappearing.
Yeah. One more question. Is it technically correct to say the corporate bonds are exchange traded? They are unlike equities. Investment banks are still involved in trading bonds, dealer inventories, etc. Aren't most
Yes.
corporate bonds traded over the counter?
No, they're not. So most corporate bonds are traded on a bond exchange. You do get corporate bonds that obviously traded over the counter. Typically, if they are being traded over the counter, they will include some sort of feature to explain why they couldn't be traded on an exchange. But the vast majority, and you even get property-dependent bonds that are traded on an exchange. And in the annuity portfolios I've worked on across a good number of insurers across the UK, the vast majority of so-called corporate bonds have been exchange traded.
Yeah, good point. One last question. Why would you not allow for unexpected defaults in the real world approach? Matching adjustment doesn't, but it should.
That's because that's how the real world approach has been defined. These definitions are quite old and they've been around for a long time. So the real world approach is just defined as historic defaults. And we're going to look at Solvency II in a moment. But essentially the short answer is because that's the way it's defined. The risk premium should include an allowance for unexpected defaults.
Okay, cool. I think we should move ahead.
Okay, thanks. So Solvency II context, and now this presentation is a little bit contentious, the relative sizes of these boxes. So we're going to start at the bottom with the risk-free rate. We're going to say the next bit is the compensation for expected cost of default and downgrade. And as we discussed a short while ago, Solvency II in particular for when backing annuity portfolios insists on including allowance for cost of downgrade because it's a fundamental feature of a matching adjustment portfolio is the credit quality of the portfolio. Then you have compensation for unexpected cost of default and downgrade, and this is essentially working our way towards the risk premium. And then you have the liquidity premium. Now, in this presentation, we're saying that the illiquid asset has a lower compensation for expected cost of default and downgrade, which is likely what most investors hope for when they invest in these assets. Because if it's not, you're not really going to achieve the benefit. Further, sometimes it is actually a legitimate expectation because you can write the contract so that it is a very secure asset. The problems arise when you're trying to model those securitizations. Right, so if we know that that bit is the fundamental spread, and we know that that is a matching adjustment. So this is really just taking the RDR and putting it into the Solvency II context. Theoretically, the illiquid asset should have a higher illiquidity premium. And again, this is a little bit contentious that it's got a higher matching adjustment, because a lot of people would hope that it would, but you really need to be able to demonstrate that you've captured sufficient risks in your fundamental spread to warrant that higher matching adjustment. And that is probably one of the biggest challenges in modeling illiquid assets, is the fundamental spread part. And we will get to that later in this session. So illiquid asset versus liquid asset, for those of you who are falling asleep, that's a liquid asset and that's an illiquid asset. Right, so modeling the RDR in the absence of data. So the RDR is often very rating dependent. When asset managers price an asset or attempt to value an asset, or when distressed debt departments attempt to value an asset, often a starting point is, what is the credit rating? And the reason is a credit rating is assumed to reflect all the underwriting done on the asset and hence reflect the risk profile of the asset. The PRA have kindly given us SS 1113, which sets out exactly how they expect this to be done. So when we want to model the RDR, we can start by looking at how would we determine the rating. Possibly the first point of call would be to consider how ECIs determine their rating. Their rating is usually consists of several processes. One is structural modeling, which is really a balance sheet projection. So we're projecting cash flows, we're projecting income volatility, and we're projecting expenses, debt service coverage, in particular debt service, not just the coverage ratios, and as much of the balance sheet as we can get our hands on and have data available for. In addition to that, we need to determine a ratings scorecard, which I'm sure many of you are familiar with, just basically setting out all the risks involved and ranking them and coming up with an overall risk score. The PRA, once again, in SS, one of the SSs, SS 317, I think it is, have set out some of the risks that they would like to be captured in the risk identification process. External market factors, cash flow predictability, particularly with regard to prepayments, collateral, and how easy is it to get your hands on the collateral, loan characteristics, refinancing, deferred payback periods. So this is quite a problem, deferred payback periods for matching adjustment funds. If it's modeled correctly, it's fine, but it tends to pose a bit of a challenge. Risks arising from third parties, there are often lots of third parties involved in illiquid assets, unlike corporate bonds, where if there is a bank involved, it's generally just one intermediary. Whereas in illiquid assets, you will have a manager, you could have project teams involved, your project managers, non-finance related. Basically the parties managing the project, especially if it's project finance or some sort of rental property where the property is being developed to be let out, you'll have management agencies and things like that involved. Legal, political, and regulatory risks. Once again, these tend to be far more susceptible to the legal, political, and regulatory risks than exchange-traded corporate bonds, partly because of the nature of the investment. So, for example, energy-related or housing-related, they tend to not just be kind of utility companies. They tend to be very specific. And then, of course, potential future risks, and that list could go on forever. So once we've done all of that, the risk ID, we generally apply some qualitative overlays, which are essentially expert judgments that allow for anything that hasn't been captured, additional knowledge, peer comparisons, whether or not we're looking at point in time or through the cycle, and anything else that's not easily factored into the scorecard. If you're wondering what the PRA has to say about all of this, quite a lot actually. Quite a few statements that they've issued that are quite helpful. Right, so we're going to have a quick look back at our paradigm. All we've discussed thus far is our credit rating assessment. What about the rest of these? I said we're not covering correlations, but we do need to look at transitions, recovery rate, and PD. So this is probably the next biggest challenge. So if we are able to determine a rating, we need to be able to model a few other things as well. And there is a lot of overlap between rating modeling and modeling transition rates and default probabilities. So we first have to define our paradigm. How do we build a model? Well, we need to define our form. Is it a structural model, a reduced form model? Are we going with stochastic or Monte Carlo simulations? Or are we going with a closed form or Heston, for example, the Heston model or the Black-Scholes? Reduced form models can take many forms. We already discussed structural models. If we're going to go with a reduced form model, we need to determine what type of regression we're going to use, Poisson regression, linear regression. What form of the model? Is it generalized linear model? And there are lots and lots of forms that we could choose from. And there are many, many books and bodies of research analyzing how best to do this. But what exactly is it that we want to model? Well, we need model variables. We've got to select what variables are worth modeling. So we start off with our fundamental feature and driver selection, filter out for collinearity. We need to look at volatility distributions. And from there, we can build a fairly simplistic model, just with a bunch of features and some volatility distributions. We need to also consider economic indicators. That was explicitly stated in one of the previous slides by the PRA, that they would like us to consider economic indicators, economic variables, and general market beta. That is the susceptibility of the asset to market conditions, or the sensitivity. The economic variables, interest rate and inflation, we would need stochastic models for, because a lot of items that we need to model, for example, prepayment risk, are inflation dependent, and the inflation path will determine whether or not prepayment happens. So probably two of the most high level features we can model, if we're going to go with a proxy model, are loan to value for property and income volatility. Now, of course, loan to value is a function of the income volatility of the property. And when it comes down to infrastructure projects, income volatility is a function of a whole host of other fundamental drivers. So if we are going to go with the highest level, we need to be very careful about selecting our volatility distributions. Last but not least, we need to determine the projection period. Is it a 1-year VAR, expected lifetime of the project, and the loan, or is it the loan period? And again, this is not just for calculating the RDR. There's a lot of overlap between this modeling and the internal ratings. So if we went with a structural modeling approach for the internal ratings, we would need to do a full project lifetime projection to understand the risks that the projects face, specifically refinancing risk. As I already mentioned, if the project cannot refinance at the end of the loan period, it's likely there is a reasonable chance that it will default on the prepayment, on the principal. Further, when we start looking at time periods, we get into the murky world of nested stochastic simulations. So it's easy to do a 1-year projection, stochastic projection, because it's just in scenarios that you're simulating. But when you start talking about trees, the computing resource becomes a bit daunting to manage. So sometimes you would need to find alternative or simplified approaches to modeling these if you're going to be looking at multiple time periods. In my experience of interviewing asset managers, specifically for the purpose of assessing their credit rating abilities, they tend to avoid full-on stochastic modeling and stick to scenario testing, just because it's easier to manage. Right. I already mentioned that expected recovery value is a function of the credit risk, and the credit risk is a function of the variables. So what is often assumed in modeling illiquid assets, for example, especially property, is that the loan to value is low. Therefore, for example, 60% or 50%. Therefore, even if a property value fell by 30%, you're still almost certain to get your money back. That's actually not true. You would have to include a fire sale or haircut, or as we said right at the beginning, illiquidity haircut, because it's going to be very difficult to sell without losing a lot of money. Secondly, the actual scenario is going to be a function, the actual loss is going to be a function of the scenario that led to that loss, which means that there's a lot of interdependency. So in a benign scenario, losing 30% of the value could mean that you would still get your money back. But in a very stressed, severe scenario, for example, everything, the whole world goes bankrupt, and the economy tanks, and you then lose 30% of the value, you haven't only lost 30%, you've lost liquidity in the market, you've lost all potential buyers, you've basically lost the property. If it falls into delinquency, you've lost the property. So the real scenarios are often a lot more severe than are assumed, and this is what the PRA are beginning to, in my experience, cotton on to, that it's not as simple as a loan to value ratio determines the value of the asset, or that the expected present value of profits determines the viability of the project. It's a lot more complicated than that. Loan covenants and features are another area to watch out for. Obviously, often what we're modeling for illiquid assets are technical defaults and proximity to cash traps, and basically technical default clauses. I guess that pretty much covers it. If there are obviously questions, I will take them at the end. Let's move on to the next slide. So what about spreads? And spread volatility. So we know that if you read the PRA's documents or their statements, that they expect the spread on an illiquid asset to be more volatile than that on a corporate bond. Furthermore, they don't just allow a direct mapping of spreads from illiquid assets through the fundamental spread in just kind of a standard way. You would need to really demonstrate that the fundamental spread that you're modeling on the illiquid asset is justifiable. So how do we actually model the asset spread volatility when we don't have any data? Well, I guess the first point is we can use sectoral indices. We can use homogeneous risk groups and relative volatility measures. We can say that a utility project should reflect the spread volatility of a utility spread index. That may or may not be the case, but it's probably a reasonably good proxy. What about idiosyncratic spread volatility? And once again, this is something that the PRA are quite concerned about, because systemic spread volatility across big issuers is quite easy to manage. But what about idiosyncratic spread volatility for a project that's being valued, marked to model? How do you actually capture that? And this comes back down to the risk discount rate and why it's so important to model the risk discount rate. Further, can you decompose a spread into credit and illiquidity, and is it actually even necessary? Well, unfortunately, it is necessary for the fundamental spread, and not just between credit and illiquidity. You would need to do a full RDR decomposition. So we'd have to look at our decomposition approaches. Real world, we know doesn't work. Risk neutral, we know doesn't work. Relative bid ask can be informative, but perhaps not as informative as we need. So relative bid ask is basically looking at illiquid assets in the market relative to more liquid assets, particularly property assets or other. And we've discussed other in our structural and reduced form modeling approaches. Another question that tends to befuddle market practitioners is whether or not an illiquid asset can become more illiquid. If by definition it is already illiquid, then surely all spread volatility is in the credit side. But we know that these spread indices largely reflect changes in market liquidity and not changes in market credit. So how does this kind of play out into the use of these for determining spread volatility measures for illiquid assets? Well, we're saying that this reflects illiquidity, but illiquidity is already reflected in the spread of the illiquid asset. So this is a challenge, and the IFOA Working Party has published a very interesting report. I don't think it was a particularly conclusive report, but it's very interesting. And they commented that basically much of the literature concludes that credit spreads are not necessarily a reliable indicator of the exact size of illiquidity premium at any point in time. Another point worth noting for spreads is that valuation managers typically determine an illiquidity premium as part of the RDR and keep it fixed for the remainder of the lifetime of the loan, as long as the loan does not experience a rating transition. This means that you can't actually use valuation managers' spreads, pricing spreads, because they only reflect the credit element of the spread, so generally with reference to some underlying basket of similar tradable bonds. And then, as I've mentioned several times, there is a question of the fundamental spread. So I'm not going to go into the fundamental spread again. I seem to have lost a slide somewhere. So let me see if I can find the other slide. No, I think it's on the PDF, which I don't have anymore. So if there are any questions or discussions, now is a good time to ask. I will find the other slide so that we can at least discuss the broader context while the questions come through.
Do you want me to share the screen?
Yes, that's a good idea. Share your screen. Thanks.
So just a second. Can you see my screen?
I can, yes, thank you.
Okay.
So that's the slide.
Yeah.
So just before we take the questions, the broader context, and this slide is really just to tie everything together in the Solvency II context, because Solvency II is really the kind of dominates a lot of what insurance companies do, especially with regard to illiquid assets. So we know that there are no standardized indices for modeling illiquid assets, so we can't use data-driven approaches for risk modeling. We do, however, need to do our IRB, so the internal ratings, feed it into our RDR, which determines our asset valuation, which determines our matching adjustment. At the same time, our internal ratings approach determines our fundamental spread mapping, which feeds into our base transition matrix. Further, the approach we use for the internal ratings will directly inform the approach we use to derive transitions, and in particular a transition matrix. And one of the factors we need to consider is whether or not we want loan level transition vectors or a full-on transition matrix for a sector. As also indicated in this diagram, the FS mapping will inform, as well as the IRB, will inform the spread volatility, transition severity, and the recovery rate distribution. In this context, PD is assumed to be the end state of the transition matrix, so the absorbing state. So it's not explicitly mentioned, it's just another kind of a transition, and that feeds into our asset loss and stress and our matching adjustment and stress. I've listed a few factors there that need to be considered. I'll just run through them very quickly, noting that we've only got about 15 minutes left. So the different levels of stochastic modeling and diversification, this is more of an internal model problem, but it becomes more pronounced for illiquid assets. As I mentioned earlier, for corporate bonds, there's lots of data and you can take more proximate approaches. When we're dealing with illiquid assets, some people will be familiar with ERMs, equity release mortgages, and even those tend to take pretty approximate approaches. For example, the Black-Scholes formula and deferment rates are really just kind of proxies for modeling full projections using a stochastic model. So there's quite a lot of work in determining that a proxy model is actually fit for purpose. Further, as we've mentioned already, recovery rates, distributions are interdependent with the overall scenario sensitivity, severity, and there needs to be a consistency between stressed fundamental spreads and the spread volatility distribution. Again, this comes down to our RDR and being able to demonstrate that whatever we use in the stressed fundamental spread actually reflects a coherent stressed RDR. So now we can move on to the questions and the discussion, please. Thanks.
Thank you, Joe. Sorry, I was muted. Thank you for a fantastic presentation. This is such a topical area with so much discussion and debate going on, especially with the regulatory interest and enhancing the knowledge base of modeling in this area. So thank you for bringing us all up to speed and giving us some banking perspective as well. So thank you for that. I'm sure all the audience have enjoyed it really well. Before I move on to question and answers, I just would like to tell the audience that NOCA has some more sessions coming in the near future. We are having a technical training course in September presented by Quanti, which is mastering pricing in PNC industry, and they are also going to cover how AI is being used. So please take a look at that and see if you are or any of your actuarial colleagues would be interested in joining that. So let's move on to question and answers. Actually, I see that there are quite a few questions in our Q&A box. So let's tackle those ones first. Joe, if you don't mind. The first one is from an anonymous attendee. Can you name the exchanges that UK corporate bonds are traded on?
Mostly the London Stock Exchange, but there will be, I mean, often the German stock exchanges, US. So, I mean, for example, there are a lot of stock exchanges. I'd say the European, the London ones, and the US ones.
Yeah. So that's great. Thank you for that. The next one is from Michael. In the current geopolitical climate and net zero, would you expect energy-related illiquid asset valuation to include risk factors accounting for geopolitical and climate risks?
Yes, and the PRA have explicitly asked for that to be considered. You'll need to demonstrate that they are irrelevant if you're going to ignore them.
Okay, cool. There's another one from Michael. He's asking, which is better, scenario testing as per asset managers or stochastic modeling, including fully nested? What are the weaknesses of scenario testing for ratings determination?
That sounds like an exam question that requires about a 2 or 3 page answer. I guess depends what you're trying to assess. Most of the asset managers do not model 1 in 200 scenarios, they only model 1 in 10, 1 in 20, or maximum 1 in 50. So when you're deriving scenarios, which takes a lot of work, you would need to consider the distribution of outcomes and the correlation and interdependency between different factors. Whereas stochastic simulation models kind of make that easier in that you don't apply that much kind of brain work to it. You let the model do it. You come up with the factors and you let the model derive it. The PRA have specifically asked for stress and scenario testing as part of also. I don't believe they explicitly asked for Monte Carlo simulation unless it is really necessary. So I think stress and scenario testing generally is expected to be more informative. But again, as I said, it's difficult to construct 1 in 200 scenarios through stress and scenario testing. And it's also the advantage of Monte Carlo simulation is that it will produce a distribution of outcomes, and you can actually assess where things lie on the distribution. And that is a key advantage when building an internal model, is to be able to demonstrate that the severity on the distribution of possible outcomes is actually at the 99.5th percentile.
Yeah, and I think it also depends on the available resources of the firm as well, isn't it? Like not every firm has the necessity to develop a full-scale Monte Carlo-based calculation engine, they might not have the resource and the expertise. So scenario-based approaches are probably a good shortcut to where they want to get to.
Yeah.
Okay, the next one is from Namdi Odozi. What are HRGs?
Homogeneous risk group.
Yeah, that's a good one. Let's close that one. Another question from Michael. How does the lack of data impact on validation of complex illiquid asset models?
That's basically what we've been discussing. Is like you can't just fit data to distributions. You've got to do bottom-up analysis, following similar approaches to internal ratings. Use structural models, reduced form models, a risk identification, and essentially try and model the risk factors. Yeah, it becomes quite complex, and obviously the aim is always to simplify and take as high level approach as possible to reduce the computing requirements. But that is how you would do it.
And data is always going to be a challenging area because we don't have data, and maybe there is some ancillary data and we don't know how relevant it is. So that's always going to be a challenging task. The next one is from an anonymous attendee. How would you build a risk model that reflects the various idiosyncratic risks that you mentioned illiquid assets can be exposed to?
So idiosyncratic risks are loan-specific risks. And again, that is very much what we've been discussing, is identification of the risks involved, which will be specific to each asset. Obviously, the challenge is that, again, the whole regulatory environment likes to box assets up into very large homogeneous risk groups, whereas in the illiquid asset world, you've actually need a bespoke model for every asset, and then you need to be able to demonstrate that if it's similar enough to other assets, that it can be grouped with those assets for transition modeling or whatever purpose. But how would you build a risk model is you would basically follow the principles that we've discussed already.
Okay, the next one is from Nikos. Brilliant presentation, Joe. Just was wondering, bundling so much uncertainty into a single number, RDR, does not sound like a sound way to communicate uncertainty. Could a model that produces a wide range of outcomes be more informative to potential stakeholders?
Yes, and also more difficult to understand for non-actuarial people. So the benefit of the RDR, and I'm certainly not advocating the RDR as the only measure of riskiness, but the usefulness of the RDR is that it gives a relative measure of riskiness quite easily. Further, when we're looking at asset valuations and we're looking at the Solvency II world, the RDR fits very nicely into the paradigms that already exist. It may not be perfect, and certainly isn't in a range of outcomes, and again, the distribution, but would you rather have a single value of your asset or distribution of values for your asset? I think most people would go with the RDR when communicating to Exco and the like.
Yeah, and I think beyond the actuarial community, in the wider financial services community, a single RDR would be like much more understood as compared to the other investment projects they are probably working with.
Yeah.
Next one is from Erica Lee. What variables do you expect to go stochastic?
Interest rate and inflation for sure. You would need those. You'd need path dependence. So when we're talking about stochastic, there's kind of, in this context, I'm assuming it's going to be, it really means path dependent. Everything else would fall off that. You would need correlations and kind of dependencies, but the idea is always to reduce the amount of stochastic modeling as much as possible and correlate things as much as possible.
Yeah, okay, thank you for that. The next one is from Tom. Do you believe illiquid assets are becoming less illiquid as more firms want to invest in them? Portfolios of equity release are often sold, albeit not on exchanges. I feel illiquid is becoming interchangeable with not externally rated.
Um, that's an interesting question. Um, so, as per the definition of illiquid, um, Investopedia or the FCA, which imply a loss of market value on sale, possibly not. Illiquid in the sense that you can't just dump it on the market. You're not going to just find a buyer for it. There are a very limited number of institutions who would be willing to purchase an equity release mortgage, and it's still going to contain a lot of idiosyncratic risk. In that context, it's still going to be illiquid.
Yeah, okay, thank you for that. The next question is very relevant to your area. You're doing PhD in computer science. So someone is asking, is there scope for AI to help us with the modeling of illiquid assets?
Definitely. So a lot of what I've looked at is using machine learning for lots of things. And really machine learning is just statistical learning. It just helps you process a lot of data and churn it out in a manner that is more simulable for humans. I guess the challenge is that there are lots of ways of using, for example, statistical learning, neural networks and the like, that are not very helpful in their current form, and they kind of need to be tailored. But definitely, I mean, AI could help with anything really. It's just kind of leveraged human brain power.
Yeah, but I think that the challenge currently still is the lack of data, and AI would need a lot of data to train.
Well, you see, that's an interesting one, because theoretically, if you were able to decompose the risk into small enough segments, you could find data for every segment. So, for example, utilities, because there is, I agree with you, data is a problem, but it may be able to create a hybrid data set that is more reflective if you're able to source sufficient data. And there is a lot of publicly available data. There's masses of data out there. It's actually assimilating that data that is a challenge. And I think there is enough publicly available data to inform illiquid models, but it's not in a conventional form. They're not tables of default probabilities for illiquid assets or spread volatility tables. But there is sufficient economic variable data. It just needs to be used correctly.
Right. Okay, thank you very much. The next one is a generic question. Someone is asking, have you ever used stochastic modeling? What is the reason behind it? And do you personally think it is easier to build that model?
Yes, so I use lots of stochastic modeling. Use them for illiquid assets, for internal models, and all sorts of other things in between, LPI volatility and things like that. I don't think they're necessarily easier than stress and scenario testing, because they require a lot of validation. But they tend to be very helpful in projecting a range of possible outcomes as opposed to a single number.
Okay, cool. We probably have enough time for two more questions. So another one from anonymous attendee. Where specifically do you see insurers under Solvency II focusing their illiquid investments over the coming years?
Well, I don't, to be honest, that's a bit of a tricky question. It's very regulatory environment dependent, as well as there are lots of kind of social factors. So, for example, social housing or education loans are very much a social thing. Solar farms are very much, again, a kind of a social benefit thing, or wind farms. I guess it's and those are very much project based, whereas you're looking at the difference between greenfield and brownfield. I don't think it's easy to say any one direction. It's more what opportunities are out there.
Yeah. Last question, Joe. Do you agree the spread for illiquid assets should be as volatile as corporate bonds?
That's another tricky question, and I've had debates with the PRA. Actually, you probably shouldn't call them debates; call them discussions,
Right.
as to whether or not they should be. In reality, they're not, because they're just not, because valuation managers just don't price using a lot of spread volatility. Whether or not they should be is a different question. And in reality, the only way you could answer that is by properly modeling the underlying risks that go into the RDR, which determines the spread. This is, again, one of the crucial reasons I've centered this around the RDR, because if you can get a handle on that, you can basically get a handle on the rest of it.
Brilliant. Thank you, Joe. I think that's all the time we have today. On behalf of everyone who's joined this session, I would like to thank Joe for such a wonderful presentation, and I would like to thank our audience for taking part in this webinar. I would also like to remind one more time that there is an AI-related pricing course that NOCA is running in September, so please have a look at our website. Thank you very much, everybody. Goodbye.
Cheers.
Cheers. Bye.